Here's the brutal truth most traders never hear early enough. Talent is irrelevant without discipline. Within the first minute, you need to accept this or the rest won't land. Nicholas Darvas did not start as a market prodigy. He was a dancer, trained to repeat precise movements under pressure, night after night. That background mattered more than any financial education he could have purchased. Amateurs enter markets seeking freedom. Professionals enter seeking structure. That single distinction determines who survives. Darvas began trading with delayed quotes, scanning the tape between performances. No real-time charts. No constant confirmation from experts. Just price, risk, and position size. While amateurs chased tips and opinions, he designed rules. While amateurs tried to control outcomes, he controlled behavior. That shift alone separated him from the crowd. The stakes are simple and unforgiving. Over 90% of traders lose because fear/greed overrides discipline at pivotal points. They oversize positions. They widen the stop-loss. They abandon patience the moment uncertainty appears. Professionals accept uncertainty and reduce exposure instead. They understand that survival is the first edge. There's a short story that captures this difference perfectly. Darvas once watched a stock explode upward while he was performing on stage. He did nothing. Amateurs would call that failure or missed opportunity. Professionals call it waiting as a position. Days later, price returned to a clear level of acceptance. He entered calmly. Risk was defined in advance. Position size was small. The stop-loss was placed without negotiation. Emotion was absent. Rule stated clearly, if you chase price, you inherit chaos. Darvas also learned early that adding complexity increases vulnerability. He resisted early pyramiding until price proved itself repeatedly. He understood that pyramiding is not aggression, but discipline layered on confirmation. That insight would later become one of his greatest advantages. Remember this maxim, because it frames everything that follows. Opportunity is infinite. Capital is not. Amateurs focus on what they might make. Professionals focus on what they might lose. One mindset dreams. The other compounds. This video will reveal how Darvas used discipline to replace prediction, how he avoided the traps that destroy amateurs, and why his most powerful rule wasn't about entries at all. It was about exclusion. About what he refused to trade, what he refused to touch, and what he refused to do when boredom tested his resolve. But before that hidden rule is exposed, you must confront the first amateur illusion that wipes out accounts faster than bad analysis ever could. The belief that more action equals more control. That illusion dies next. This lesson alone can save years of frustration, thousands of dollars, and the emotional cost of repeating the same mistakes again unnecessarily. Amateurs equate control with activity. Professionals know control begins with restraint. Early in his journey, Darvas overtraded. After a string of wins, confidence swelled. Fear/greed disguised itself as certainty. He increased position size without increasing clarity. Losses followed. Not devastating, but instructive. This pattern is universal. Success loosens rules. Failure tightens them. Professionals reverse that instinct. Darvas noticed his biggest drawdowns didn't come from bad analysis. They came from rule drift, from trading too often, from feeling the need to always be involved with the tape. So he implemented a protocol. Fewer trades. Higher standards. No trade unless risk could be clearly defined at entry, at the pivotal point where right and wrong separated cleanly. If a setup didn't allow a logical stop-loss, it didn't deserve capital. Rules stated explicitly, if you feel bored, you're probably trading correctly. Darvas capped position size aggressively. Not because he lacked conviction, but because conviction doesn't reduce uncertainty. Small size preserved emotional neutrality. Neutrality preserved patience. Patience allowed confirmation to appear without forcing action. Waiting as a position became a deliberate choice, not an excuse. His stop-loss placement evolved too. He stopped placing stops where they felt comfortable or hidden. He placed them where the thesis failed objectively. That is professional thinking. A stop-loss is not protection from loss. It is protection from denial. There was a moment that burned this lesson in. Darvas watched a small loss turn into a large one because he hesitated. The tape warned him. Fear whispered to wait. He paid tuition. After that, stops were automatic. Maxim, if a loss hurts emotionally, your position size was wrong. Pattern interrupt. Doing nothing is sometimes the most profitable decision. As restraint increased, clarity improved. Darvas began to see how many trades existed only to satisfy boredom. Those trades disappeared. Capital lasted longer. Confidence stabilized. Risk stopped feeling threatening and started feeling measured. Discipline was no longer a mood he hoped to maintain. It became a system he followed even when emotions disagreed. But beneath restraint lurked a more seductive amateur impulse, one that feels logical and generous to the ego, fixing a losing trade by adding to it. That impulse would cost Darvas real money before it taught him its lesson. Understanding why adding to losers violates every professional principle requires confronting how fear disguises itself as intelligence. That confrontation comes next, and it changes how you see pyramiding forever. It reframes risk, redefines patience, and exposes why confirmation must always precede commitment, never follow it, especially when position size tempts emotion. The pivotal point feels close, and the tape seems friendly, but discipline quietly demands restraint instead. This is where amateurs break and professionals finally separate. Averaging down feels intelligent to amateurs. Professionals see it as surrender. Darvas tried it early. Price dropped. He added. Price dropped again. He added again. Each addition increased emotional exposure. Fear replaced clarity. The tape didn't care about his logic or his confidence. At first, averaging down felt responsible. He told himself he was improving price and managing risk. In reality, he was increasing position size at the exact moment information was worsening. The pivotal point had already failed, but ego refused to accept confirmation from price. Then he stopped fighting price entirely. Darvas flipped the rule completely. He only pyramid winners, never losers. Only after price proved itself by breaking to new highs and forming a new box. The pivotal point was evidence, not hope. If the market didn't reward him first, he refused to reward himself. One scene matters. A stock breaks out, consolidates calmly, then breaks again. Instead of taking profits, Darvas adds a small unit. Position size grows only because risk shrinks. His stop-loss moves upward beneath the new box. Loss becomes impossible. Amateurs feel fear here. Professionals feel alignment. Rule stated plainly, pyramiding is a reward, not a rescue. This rule required patience most traders never develop. Waiting as a position meant resisting the urge to feel busy. Confirmation was not a feeling or a forecast. It was the tape holding above resistance, day after day, without collapsing. Fear/greed invert logic. Fear encourages cutting winners early. Greed encourages adding to losers. Darvas reversed both impulses by design. He added only when fear tempted him to take profits. He waited when greed urged action. Maxim, only add when the market agrees with you. Pattern interrupt. Confidence comes from structure, not prediction. This single rule changed his equity curve. Small wins became large trends. Losses stayed small and boring. Risk was contained automatically. Position size expanded only after uncertainty contracted. Now notice how this connects. Risk is controlled. Position size is managed. Pyramiding is disciplined. Emotional damage is minimized. Yet one critical question remains unanswered. How did Darvas decide which stocks deserved attention in the first place? He didn't search harder. He eliminated more. His filter removed most opportunities and most mistakes simultaneously. That filtering rule explains why he could wait without frustration, why boredom became an edge, and why amateurs watching everything still missed what mattered. That filter comes next, and once you see it, you'll realize most of your effort has been misdirected. It will force you to confront how simplicity amplifies discipline, how patience compounds risk control, and why professionals survive by saying no repeatedly, while amateurs exhaust capital-chasing movement, noise, and constant confirmation everywhere until losses finally teach restraint hard way. Amateurs ask, what should I buy? Professionals ask, what must I ignore? Darvas eliminated aggressively. Thousands of stocks existed. He watched fewer than 20. Attention was treated as capital, not entertainment, not stimulation, not proof of intelligence. Early on, he followed tips. Broker calls. Newspaper stories. Friends with inside information. Each story sounded reasonable. Each loss felt unlucky. Over time, a pattern emerged. The tape contradicted narratives again and again, exposing how confirmation comforted fear rather than rewarded discipline. Darvas imposed a brutal filter. If a stock wasn't making new highs, it didn't exist. No anticipation. No bottom fishing. No bargains justified by opinions. New highs signaled institutional demand. That demand, visible on the tape, became his only confirmation. Rule stated explicitly, price leads, stories follow. He built boxes not to predict direction, but to define risk. A box created boundaries. Below it, he was wrong. Above it, he acted. The pivotal point was clear. Stop-loss placement became mechanical. Patience stopped being emotional and became procedural. Amateurs fear buying highs because they fear being wrong publicly and immediately. Professionals fear ambiguity more than embarrassment. They understand unclear risk destroys discipline faster than small losses ever could. Maxim: clarity is more valuable than price. Pattern interrupt: waiting is not passive. It is selective aggression. This filtering changed everything. Trades decreased. Stress decreased. Consistency increased. Position size felt lighter. Risk felt contained. Waiting as a position felt natural, not forced. Fear/greed lost leverage because decisions were simplified before emotion appeared. But discipline does not survive without reinforcement. Rules weaken after wins and wobble after losses. Darvas needed a way to maintain emotional distance across cycles. That mechanism didn't come from markets. It came from dance. From repetition, rehearsal, and execution without debate. That transfer completed his transformation, and it explains how he stayed consistent while others burned out repeatedly. This discipline extended into daily routine. Darvas reviewed notes, respected schedules, and limited exposure to noise. He did not watch every tick. He checked levels. He trusted preparation. Amateurs chase reassurance through screens. Professionals rely on predefined rules. This separation preserved patience during quiet markets and clarity during volatility. By reducing decisions, he reduced emotional fatigue. Risk stayed constant. Position size stayed appropriate. Stop-loss execution stayed automatic. The tape remained the authority. Each day became a rehearsal, not a performance. And rehearsed behavior holds when pressure arrives unexpectedly. This consistency separated professional identity from amateur impulse permanently. It allowed him to wait through drawdowns, trust confirmation, and execute without hesitation at the pivotal point. That internal order is why discipline, not talent, ultimately scaled his results. Nothing else was required. And nothing else mattered. Especially not excitement. Or constant action. Ever. Darvas treated trading like choreography. Repetition over inspiration. Amateurs improvise daily. Professionals execute pre-written scripts. Darvas documented everything. Every entry. Every stop-loss. Every position size decision. Writing externalized discipline and reduced emotional leakage during pivotal moments. A small but critical story explains why this mattered. After a clean loss, Darvas did not revenge trade. He closed the position, stepped away, and reviewed the rule involved. If the rule was followed, the loss was accepted as normal risk. If the rule was broken, behavior was corrected immediately. Outcome was irrelevant to judgment. Rule stated clearly, judge yourself by execution, not profit. Fear and greed thrive in ambiguity. Writing removes ambiguity. It exposes impulse before it hardens into habit. It enforces patience when the tape feels urgent. Waiting as a position becomes easier when decisions are already written. Darvas kept simple records. Entry price. Stop-loss level. Position size. Reason for entry. No predictions. No opinions. This forced confirmation to come from price alone. The tape either validated the trade or invalidated it without negotiation. Maxim: you do not rise to your goals, you fall to your rules. Pattern interrupt. Boredom is a sign of professional execution. This process allowed Darvas to trade while traveling, performing, and living normally. Discipline was not emotional. It was mechanical. He did not rely on motivation. He relied on preparation. Amateurs wait to feel confident. Professionals act when rules align, regardless of mood. There was another benefit. Documentation slowed decisions. Slower decisions reduced mistakes. Reduced mistakes protected capital. Protected capital preserved confidence. Confidence reinforced patience. The loop fed itself quietly. Losses still occurred. Drawdowns still appeared. But they no longer felt personal. Each loss was simply information about adherence to process. Risk stayed defined. Position size stayed contained. Stop-loss execution stayed automatic. Most traders collapse during losing streaks because emotion compounds faster than losses. Darvas prevented that compounding by shrinking decisions, not avoiding pain. He trusted that consistency would outlast discomfort. One final insight emerges here. Discipline is not willpower. It is architecture. Build it once, then follow it when fear and greed are loudest. That realization prepared Darvas for the moment every trader dreads. The losing streak that tests identity itself. How he responded is the dividing line between amateurs who quit and professionals who compound steadily over time. That response relied on shrinking risk, cutting position size further, honoring every stop-loss, and trusting the tape at each pivotal point. Patience replaced urgency. Waiting as a position protected clarity. This preparation ensured pyramiding resumed only after confirmation returned, proving discipline survives stress. Professionals endure this phase. Amateurs abandon structure precisely when it matters most and lose everything they worked for eventually. Losing streaks break amateurs. Professionals expect them. Darvas accepted that losses cluster naturally in probability-based systems. He did not panic or search for new strategies during drawdowns. He reduced position size immediately. Risk first. Always. When uncertainty increased, exposure decreased. A key anecdote illustrates this restraint. During a losing period, Darvas cut size in half across all trades. Not because his system failed, but because emotions were vulnerable. Smaller size restored neutrality. Neutrality restored patience. Patience allowed confirmation to appear again on the tape. Rule stated plainly, when uncertain, trade smaller, not smarter. This rule protected him from the most dangerous amateur reaction, forcing intelligence onto randomness. Amateurs add indicators. Professionals subtract risk. Darvas understood that clarity returns only after emotional pressure subsides. He never removed stop-losses during drawdowns. He never widened risk to get back to even. Each stop-loss stayed exactly where the thesis failed. Recovery was a byproduct of discipline, not effort or hope. Waiting as a position became essential during these phases. Fear and greed behave differently in losing streaks. Fear pushes hesitation on valid setups. Greed pushes overtrading to recover losses. Darvas neutralized both by reducing position size until trades felt boring again. Maxim: survival precedes success. Pattern interrupt: the goal is not to avoid losses, but to make them irrelevant. This mindset preserved capital and confidence simultaneously. Capital survived mathematically. Confidence survived psychologically. The tape regained authority over emotion. The pivotal point regained clarity. Decisions slowed. Execution improved. Darvas also stopped tracking profits during drawdowns. He tracked only rule adherence. That prevented confirmation seeking and narrative building. Each trade became independent again. Risk remained defined. Position size stayed small. Pyramiding stopped completely until confirmation returned. He refused to add exposure until price behavior proved stability. This discipline allowed losing streaks to end quietly. Not with heroic trades, but with normal ones. Small wins. Clean losses. Gradual recovery. Amateurs interpret drawdowns as personal failure. Professionals interpret them as statistical phases. That difference determines longevity. We are close now. Most rules are on the table. Risk control. Position size discipline. Stop-loss integrity. Patience under pressure. Tape authority. Waiting as a position. But the final Darvas principle ties everything together. It explains why a dancer outperformed analysts, why structure defeated intellect, and why mastery in trading looks boring from the outside but feels unshakable from within. This final insight reframes mastery entirely. Professionals do not conquer markets. They contain themselves. Discipline is not rigidity. It is flexibility anchored by rules. Darvas survived storms by shrinking sails, not fighting waves. That restraint prepared him for the final principle, where identity fully replaces technique. That principle completes the framework and explains why amateurs cross the line. Darvas mastered emotional distance. Amateurs identify with trades. They celebrate wins as proof of skill and mourn losses as personal failure. Professionals observe trades. They understand that outcomes are signals, not judgments. Darvas never needed to be right. He needed to be consistent. Consistency compounds. Being right occasionally does not. He treated trading as probabilities, not predictions. Each trade was one of many, a single experiment in a vast statistical landscape. No single outcome mattered. Position size ensured that even extreme moves could not disrupt discipline. Amateurs risk too much on one trade. Professionals manage exposure to survive all trades, knowing survival itself is the primary edge. Rule stated explicitly, if one trade matters too much, you violated risk. This distance allowed patience. Waiting as a position became natural, not forced. Confirmation came from price action, not ego or hope. Darvas relied on the tape to validate moves. Breakouts, pivotal points, new highs, these signals replaced emotional judgment. Fear/greed lost leverage because every action was checked against a mechanical system rather than impulse. Maxim: detach from outcome. Attach to process. Pattern interrupt. Calm is not confidence. It is clarity. This emotional neutrality was not innate. It was engineered. Through rules, through structure, through repetition, and through documentation. Darvas wrote down every trade, every stop-loss, every position size. He reviewed deviations from protocol immediately. Losses were data, not drama. Gains were evidence of adherence, not genius. Over time, this created a psychological buffer, insulating him from the noise that destroys amateurs. He no longer reacted to market chaos. He anticipated it as part of the framework. Drawdowns did not provoke panic. Breakouts did not excite greed. Each day became a rehearsal. Discipline became mechanical. Patience replaced impulse. The pivotal point dictated action, not emotion. Now all open loops converge. Risk control, position size discipline, stop-loss integrity, pyramiding rules, waiting as a position, tape confirmation, they all feed into the same principle: trade without attachment. Discipline was not a personality trait. It was a framework. A system capable of producing consistency even when randomness is maximal. Amateur behavior arises when process breaks. Professional behavior arises when process persists. Darvas' edge was this structural detachment. Not insight. Not prediction. Not instinct. Every rule reinforced neutrality. Every written procedure enforced patience. Every confirmed breakout validated action, not belief. Through this, he transformed emotional volatility into strategic calm. In the next chapter, this framework will be distilled completely, showing how all the rules, anecdotes, and lessons combine into a single actionable mindset that can be applied immediately, without reliance on genius or luck, proving why discipline outperforms talent every time. The Darvas framework is simple, not easy. Amateurs seek certainty. They want to know the outcome before committing. Professionals design resilience. They accept uncertainty and structure every decision around surviving it. Darvas focused on protecting the ability to play tomorrow, understanding that longevity in the market compounds advantage more than any single insight. Risk was predefined. Position size was deliberately small. Stop-loss was non-negotiable. Pyramiding occurred only under strict conditions. The tape, not opinion or prediction, was authoritative. Pivotal points were objective, not subjective. Patience was respected. Waiting as a position was honored. Confirmation was demanded before any additional commitment. Rules stated clearly, consistency beats brilliance. Darvas did not attempt genius. He attempted reproducibility. He built his system so that even under stress, execution would follow the same disciplined protocol. He understood that emotional stability is the core currency in trading, more valuable than intuition or timing. By containing emotion through strict adherence to rules, he created space to act decisively when the market signaled opportunity. Maxim: the market rewards respect for uncertainty. Pattern interrupt: complexity is often avoidance. Amateurs overcomplicate to feel control. Professionals simplify to ensure clarity. Darvas filtered relentlessly. He ignored distractions. Every additional variable introduced risk without reward. His attention was capital, and he allocated it sparingly. Waiting became an advantage rather than a frustration, because fewer trades meant clearer judgment and preserved capital. The tape became a teacher rather than a test. One final question remains: can this framework be reduced to something immediately usable? The answer is yes, and its simplicity is deceptive. The actionable rules are straightforward but demand discipline. Define risk first, keep position size small, honor stop losses, pyramid only when evidence supports it, trust the tape, act at pivotal points, respect patience, wait as a position, and demand confirmation. Apply these consistently. Nothing more. Nothing less. Amateurs chase noise, excitement, and validation. Professionals follow the process. Darvas' edge was not intelligence. It was structural control over behavior. By reducing trading to clear, repeatable rules, he transformed emotional volatility into mechanical advantage. The system enforced neutrality, protected capital, and allowed compounding to work over time. Every decision became predictable in terms of process, not outcome. Survival became automatic. Patience became natural. Clarity replaced anxiety. This reduction is the true lesson. The framework works because it limits discretion, protects the account, and aligns behavior with reality. Every rule ties back to one principle: preserve capital, reduce emotional interference, and trade only when evidence supports it. Mastery is not prediction. It is process. Discipline, structure, and patience create results that raw talent alone cannot. Darvas didn't chase mastery. He enforced simplicity. Amateurs believe mastery is flashy, obvious, and immediate. Professionals know mastery is boring, patient, and cumulative. Darvas accepted boredom. He accepted missed moves. He accepted small gains. Over time, compounding performed the heavy lifting. The market does not reward emotion or haste. It rewards discipline applied consistently. Waiting as a position, adhering to stop losses, controlling position size, and respecting pivotal points. All of it compounds quietly, almost invisibly, until results are undeniable. Amateurs want excitement. Every day they seek new ideas, new charts, new signals. They interpret movement as opportunity. They misread volatility as validation. Professionals want longevity. They accept that most of the market is irrelevant. They focus on the few opportunities that fit their rules. They allow patience to shape timing rather than letting fear and greed dictate it. Rules stated plainly, boring systems survive. Darvas' approach illustrates this perfectly. He limited exposure to the tape. He tracked only those stocks meeting his criteria. He did not chase stories. He did not anticipate reversals. Each trade was mechanical. Each stop loss predefined. Position size small. Pyramiding disciplined. Risk controlled. Confirmation verified. He did less, but executed better. Each action reinforced consistency, and over time, profits accumulated without drama. Maxim: do less. Do it better. Pattern interrupt. Simplicity scales. Complexity compounds mistakes. Boredom in trading is a feature, not a bug. Waiting is productive. Non-action is often the highest probability trade. Darvas' genius was not his stock selection, but his ability to follow rules under pressure. Emotional neutrality was engineered, not accidental. Process replaced passion. Structure replaced impulse. Execution replaced speculation. Application is immediate. Cut losses fast. Size small. Wait. Own the process. These 4 imperatives reduce discretion to a minimum, enforce emotional control, and ensure that the pivotal points of the market guide action rather than ego. They make every trade survivable, every loss tolerable, and every gain cumulative. Amateurs trade to feel right. Professionals trade to survive and grow. The difference lies in adherence to simple rules under pressure, not in clever ideas or market predictions. Darvas' system proves that simplicity outperforms complexity. Repetition outperforms instinct. Patience outperforms desire. Compounding outperforms ambition. And that is the ultimate professional edge, designing a boring, repeatable, low-risk framework that produces extraordinary results over time. Every step of his method reinforces neutrality, and every trade becomes a reinforcement of process rather than emotion. That is why boring systems survive while flashy ones fail, and why process always beats prediction in the long run. Everything loops back to discipline. Darvas wasn't special. He didn't possess secret insight or extraordinary intelligence. What set him apart was structure. He replaced emotion with rules. He replaced prediction with process. Each decision was pre-encoded in a system designed to survive uncertainty, manage risk, and enforce patience. Talent alone could never produce the consistency that his framework guaranteed. Amateurs rely on inspiration. Professionals rely on architecture. That architecture is what converts randomness into opportunity. Darvas built every rule around a single guiding principle: protect the ability to trade tomorrow. Risk predefined. Position size small. Stop loss inviolable. Pyramiding conditional, never impulsive. Tape authoritative. Pivotal points objective. Patience respected. Waiting as a position honored. Confirmation demanded before committing additional capital. Every trade became a rehearsal of discipline rather than a test of courage. The psychological payoff was enormous. Emotional neutrality became second nature. Fear and greed no longer dictated entry, exit, or position adjustment. Losses were interpreted as data, not failure. Wins were interpreted as validation of process, not genius. Waiting as a position transformed from a source of anxiety into an instrument of compounding advantage. The pivotal point, the tape, and predefined rules dictated action, removing ego from the equation entirely. Rules stated clearly: survive first, profit second. Darvas' final maxim: cut losses fast. Size small. Wait. Own the process. 4 directives, deceptively simple, but capable of transforming behavior in chaotic markets. Cut losses fast to prevent emotional contagion from undermining clarity. Size small to ensure that no single trade can destroy composure. Wait to let confirmation emerge before committing capital. Own the process so that every action is governed by rules, not impulse. Apply these consistently, and every amateur impulse becomes a professional habit. Pattern interrupt. The market does not reward genius, it rewards patience executed with structure. This framework reconciles every principle explored in previous chapters. Risk management, position sizing, pyramiding, filtering, patience, tape reading, waiting as a position, all converge into a cohesive system that emphasizes survival over thrill. Discipline is the lever that magnifies compounding. Process is the lens that transforms volatility into opportunity. The pivotal point becomes a signal rather than a threat. Emotional neutrality becomes an edge rather than a constraint. If you learned how discipline outperforms intelligence, you now hold the foundation to survive, execute, and compound in a chaotic market. The next lesson on trend persistence will deepen this understanding, teaching how to identify continuation opportunities, confirm strength, and expand positions without sacrificing the structural advantage you have just built.